Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets. And I'd like to welcome everybody to another live analysis session. We're, of course, going to be analyzing the market together in real time. We're going to be looking at technical analysis. We're going to be looking at fundamental analysis. We're even going to be looking at different aspects of the market which can have a domino effect on different assets. So building a strong bias on how today's announcement is going to send shockwaves across the financial trading markets. Today, we're going to be looking at what is known as the US CPI. Now, some people may have not have heard of the CPI. The CPI is just an abbreviation for Consumer Price Index. Even if somebody says Consumer Price Index, what is the Consumer Price Index? We're going to look at everything in very basic terminology so everybody fully understands, builds a strong foundation. But of course, when the announcement is taken and made public in 15 minutes time, everybody is prepared and knows different methods and ways in which they potentially can predetermine how the market is going to move. So we're going to be looking at indicators, we're going to be looking at price action as well, momentum, and what that means for the price of different assets. Some of the world's most traded assets, like the EURUSD, the Nasdaq, S&P 500, the DAX, gold, oil, and so on and so forth. But very first, I want to go quickly through what the CPI is and why it's so important. Because keep in mind, guys, that next week we will have the Federal Reserve and the Federal Open Market Committee announce their interest rate decision and how they will amend, if they will amend, the federal fund rate. And of course, if they're going to amend the federal fund rate or the decision, generally speaking, it can create a lot of volatility, and it is hanging on today's announcement. We've got a good idea on what the Federal Reserve potentially may look to do because of last week's employment and economic data as well. But this is the showstopper. This is where the spotlight currently is. So what is the Consumer Price Index, the CPI? It is inflation, ladies and gentlemen. It is the US inflation announcement. So the CPI, Consumer Price Index, like we can see here, we've actually got two versions of the CPI. We have the CPI, which is basically an index of goods and services such as food, drink, tobacco, medicine, real estate, and services, and so on and so forth. And basically, the index will measure every single month how the price has altered. Now, if the price is increasing in value, it is inflation, like we're seeing currently. Maybe a few years ago, when we were looking at it, we actually saw hyperinflation. So just after COVID-19, we saw very high levels of inflation. If it's actually decreasing the index, then we see what is known as deflation. There's two types of CPIs. We've got the standard CPI, which we can see here, which is currently based on analysts' expectations, is expected to increase from 2.6% to 2.7%. But we've also got a second version, which is known as the core CPI. Now, the core CPI sometimes is looked at more by the Federal Reserve, depending on the current market conditions. Today is definitely going to be a major announcement. So I would say it's equally as important as the standard CPI. The only difference, ladies and gentlemen, is that the idea of the core CPI is for it to exclude certain goods and services which are extremely volatile. So the idea is that it's a safer and less volatile, more certain reading of inflation, even though it's excluding the two things which we spend most of our money on. So yes, it's not as maybe important to everyday consumers, but it is extremely important to the regulator in America, to the Federal Reserve. So we've got two announcements. The core CPI is expected to remain the same. It's expected to remain at 3.3%. The standard CPI is actually expected to rise. Why do we care though? if we're looking to build a portfolio of stocks, if we're looking to trade CFDs, if we're position traders, if we're actually looking to buy and earn from dividends, whatever type of investor we are, if we're trader building a portfolio, longer term investors, if we're scalpers, whatever type of investor or trader we are, everybody is looking at two things: the CPI and the interest rate decision. And why is that? Because, ladies and gentlemen, if the CPI indeed increases in value, then it puts more pressure on the Federal Reserve to not cut interest rates. Because interest rates are high, they're currently slightly above the traditional level, which is known as the neutral monetary policy level. It's slightly higher. So interest rates are quite high at the moment. Yes, we've had a cut, but they're still high. The reason they're high is because they're trying to bring inflation down. Because if inflation is too high or extremely high or at hyperinflation level, then it can significantly damage consumer demand, which has a ripple effect throughout the rest of the economy. So if we're going to get that scenario, ladies and gentlemen, where inflation does increase to 2.7% or even 2.8%, there is a lot of pressure on the Federal Reserve to say not to cut interest rates. And the possibility of them not cutting interest rates is going to significantly increase. I'll actually show individuals a tool which we use within the financial trading markets. This is actually from the CME group, basically the Chicago exchange. It's the FedWatch tool. Look at what is currently being priced within the market. This is the market's expectation of what is going to happen next week from the Federal Reserve. So this is actually a tool which you can use, again, in order to help you understand the market condition and how the market is looking to price in different assets, whether it's individual stocks, indices, ETFs, and currencies. At the moment, interest rates, of course, are between 4.5% and 4.75. Now, 86, more than 86% actually, believe there's going to be a 25 basis point rate cut. Only 13% believe they're not going to cut interest rates. But what you will see is if this comes in higher than expected, and also, like I said, we're going to be looking today also at the core CPI. If that also comes in higher than expected, then the possibility of an interest rate cut will significantly decline and a pause will increase in value. That doesn't necessarily mean that it's going to switch on its head and we're suddenly going to see 90% believe there's going to be a pause. But the difference between the two will become significantly less. And what does that mean, ladies and gentlemen? If we go to our charts, this is a 3-minute chart, ladies and gentlemen. This is the NASDAQ. It means that if inflation is higher than expected, core inflation and standard inflation, which will have that effect on the Federal Reserve and pressure them not to cut interest rates, then it can have a damaging effect on the stock market. Why? Because number one, the US dollar will increase in value. And because the US dollar increases in value, all foreign buyers, it's more difficult and more costly to invest in US stocks. This is one reason. Another reason is there's going to be higher interests on fixed accounts, savings account. There's going to be higher yields in the bond market. So they're less tempted to invest in a more riskier asset. They would rather just stick to savings, fixed accounts, bonds, treasuries, and so on and so forth. Because if interest rates aren't going to be cut, they're going to be earning more on those assets. So why risk more? Whereas if they're going to cut interest rates, everybody earns less from that sector of the economy. So what they do is they limit their exposure to that sector and increase their exposure to other sectors where there's higher risk, higher potential returns and growth, and so on and so forth. The last thing I will say is if interest rates remain high, it means consumers are charged more on debt. Investors are charged more on debt. Businesses and companies are charged more on debt. and so on and so forth. So people spend less. So these companies within the Nasdaq, within the S&P 500, they earn less as well. So that's a higher risk and potentially lower dividends and potentially lower growth as well. So it can have a negative effect on the stock market. But if we see it coming less than expected, maybe if it comes in as expected, potentially that's not enough to drive the price of the market higher. But if it comes in potentially less than expected, then that can have a very strong effect on the stock market and really bring the stock market momentum significantly stronger, faster, and the price significantly higher as well. Potentially, that's not guaranteed, so we always need to prepare for different price movements within the market. Whereas if we're looking at the stock market, sorry, if we're looking at the US dollar index, it will have the opposite effect. The stronger the CPI and higher the CPI is, the better it is for the US dollar. If it's weaker than expected, that can definitely pressure the US dollar because the chance of them cutting interest rates is significantly higher. So if they cut interest rates, the US dollar is less in demand. So hopefully now people are getting a good understanding about why we're looking at inflation. That it has that effect down the road, down the line on the Federal Reserve and their interest rate decision. And depending on that decision, we will see, of course, the market switch from one asset to another asset and change their exposure to different categories within the market. So this is extremely important because it creates a lot of volatility. When we're about to get that volatility in 3 minutes time, of course, we're definitely going to take that into consideration and look to how we can use that to trade accordingly. Now, if we're going to look at the NASDAQ is currently trading above the 75 bar exponential moving average. It's trading above the 100 bar simple moving average, but we're trading below the RSI at the moment as well. We're not seeing any divergence, so there's no indication that the price movement is trading outside of its intrinsic value. But we're at a level now where one indicator is indicating that there's a bullish bias within the market, whereas the RSI is indicating that we're actually at a neutral level. So there is a slight bias towards upward price movement, but it's not definitely a bullish price movement indication across the board. Of course, if we're going to switch to a smaller time frame, we also trading above the 75 bar simple moving average. On a small time frame like the 3 minutes, a lot of people they switch to a 200 bar simple moving average, but either way we're still above. The latest crossover is an upward crossover here. We've definitely increased above the recent highs here, so this is another bullish indication, and the MACD is also trading significantly higher as well, and in the positive zone. The only thing I will say is it's all going to be dependent on the announcement of the CPI. If it's going to come in lower than expected, as expected, we can see even as we're speaking, guys, and I'm pointing out all of these bullish indications. This is why we have live analysis sessions. Even as I'm pointing out all of these bullish indications, the price is significantly increasing. But we're about to have the announcement, ladies and gentlemen, just in a few seconds' time. So it's extremely, extremely exciting to see what is about to happen with the market. The price is shooting upwards at the moment. We look at just what's happening over the past minute. The price of the Nasdaq's increased 0.11% just in a minute time. Let's see what's about to happen, ladies and gentlemen. We're only 10 seconds away from the announcement. So let's see what's about to happen, how it's going to affect the market and the Nasdaq. We've said there is, that bullish bias, but is that going to be backed by the announcement itself? Is it going to be backed by the announcement itself? That's what we need to know. So if we're going to look at the announcement here, we can see it's actually come in as expected. So we got the 2.7%. We have seen an increase. We've also got the core CPI, which has come in as expected as well. So it has come in as expected. So if we look here, ladies and gentlemen, we're going to look at how the market, generally speaking, has reacted. Look at the indices here. So we can see the Nikkei 225 increase in 1%, the Nasdaq's increase in value, the Russell 2000's increase in, S&P 500 is slightly higher, the Euro Stocks 50 is also slightly higher as well. But it has come in as expected. So we haven't had something higher to indicate that, yes, indeed, we are going to have a decline in the stock market, but we also haven't had something lower indicating that we're going to see, a significant, very, very strong bullish trend in the stock market. But the indications that we have spoken about just over the past 5 minutes only have come to light. So we said, we're above the trend line, we're above the price sentiment line. We were at the neutral level, but now we're above the neutral level. We look at a 3-minute time frame. We've got a lot of indications of bullish price movement. And if we look at, again, just the price movement we've seen on this candlestick alone, ladies and gentlemen, previously it was 0.11%. Now we're looking at 0.16%, ladies and gentlemen, and rising. It's still increasing in value. Again, guys, this is why we have these sessions. Now, if we're going to go into a larger time frame, the 2-hour time frame is extremely important while we're trading. Of course, there's different areas of the market that people may potentially be aiming for. Now, number one, a lot of people are probably going to be aiming for this level and this level here. Now, these are resistance levels. Now, because these are resistance levels, a lot of people have different theories and different methodologies in regards to them and aiming for these levels. We know the price can reach it because we've previously reached these levels. So, and we also know that investors are comfortable with those levels as well because we've traded at them. We're not trading here at an all-time high, for say. But what a lot of investors do is, in order to slightly take a less, I should say, a risk-averse approach to, not a risk-free, but a slightly less risky approach to the market, is they'll look at the current price and say, how far away are we from the resistance point? So we're looking at 0.44% here, and here we're looking at 0.86%. What a lot of investors will do is they'll look at 75% of the distance from the current price to the resistance level. And the idea is, if we don't go as high as that resistance level, we look at 75% because it's slightly closer, less price movement is needed, and there's a lower risk, should we say, of the price increasing in value, not quite reaching that point, and then starting to decline, and then we miss the take profit. By the way, guys, if you've got questions, feel free to ask. I've got a lot of questions. Some people have given me some assets to look at, so we'll look through the list of different assets in a moment. I can see somebody here says, great. Okay, so somebody here really likes the fact of looking at 75% of the resistance level, not the full resistance level itself. But the gentleman has said, is there other options as well? Now, what also people can do is they can also look at scaling in and scaling out as well as an option, of course. So what a lot of individuals do is, I'll put it, actually, let's go to a 15-minute time frame. That might be easier for people to look at. Like so. So what a lot of people will do is that, maybe somebody's instantly buying here. Let's put the buys in blue. Actually, let's make it green because we've got blue candlesticks here. So we've got a buy here, for example, because we've been speaking about a buy for quite a few minutes now. What some people will do is they'll look at scaling in. So they'll go, for example, 9% higher. So at this price here, they'll enter a second buy. And then let's see if that's at 0.9%. We need that slightly higher. And then another 0.9% they'll go slightly higher. So there, they'll enter a third trade, and then 0.9% higher again. So there. There we go. So this is known as scaling in. So what's the idea of scaling in? The idea of scaling in, ladies and gentlemen, is not to overexpose yourself. It's not to increase the level of trades that you are opening. The idea of scaling in, ladies and gentlemen, is to open more trades, smaller trades, at different prices and also at different times. So you're mitigating the risk, you're spreading the risk across different times and different prices. So instead of opening one lot here, you can open 0.25, 0.25, 0.25, 0.25. Now this is scaling in. Now some people may say to scale out. So for example, they may close all of the trades here. So if you're closing all of the trades at one price, let's say here, you're not scaling out, you're just scaling in. But if you're closing maybe from the 4 trades, 2 of them at that first red line, and then at the second red line, for example, up here, closing the second 2, then you're scaling out. And now this is also very helpful when you're looking at really volatile markets as well. And today's CPI, it's not extremely, we're seeing some nice volatility without doubt. And we've been speaking about a buy for 12 minutes now. Anybody that has bought is currently in profit at the moment. But scaling in is also an option as well for people that want to spread the risk across different times, different prices, and so on and so forth. Because if you get a lot of volatility, if you opened, for example, a sell trade, so the market moved against you. If you open one large sell trade here, the market's moved significantly against the whole trade. But if you opened half the size here and then a second trade here, so you're looking to scale in, the market never ever went to that second trade. So the market's moved against you, but only half of the amount that it would have if you opened the larger trade at that single price. So this is the idea of scaling in, ladies and gentlemen. Now, what's really going to be interesting is how this has changed the FedWatch tool. Now, keep in mind, we may not see a big difference yet because the market hasn't opened. We've still got almost an hour until the market opens. So we're seeing slightly higher possibility of an interest rate cut because we didn't see higher than expected. But it's not, ladies and gentlemen, yet seen a lot of volatility. It's slightly increased from 86 to almost 88. So keep that in mind, that after the US market opens, we may see more volatility here, ladies and gentlemen. Now, what's really interesting is that the VIX is trading significantly lower. If we look at the VIX here, the VIX is trading more than 1% lower. The VIX is known as a risk indicator. So if the VIX is lower, it means people have a higher risk appetite. If people have a higher risk appetite, it actually means that people tend to invest more into the stock market. So it could be a positive sign for the NASDAQ, S&P 500, and Dow Jones. If the VIX continues to rise, that's a continuation of a good sign. Now, if that starts to increase in value and is no longer in a minus, then that can potentially indicate a retracement correction or some kind of downward price movement. If people also want another indication on a risk, based on risk, because risk and sentiment within the market is extremely important. Yes, one thing is the VIX index. The second thing is people can look at the high-low index as well. The high-low index is also known to be an indicator of risk appetite and sentiment towards an asset. This is also something people can look up, which is very helpful as well. So we're going to look at some other assets as well. We're going to look at gold. Somebody says here, gold. Let's look at what other assets people want to look at. A lot of people are saying USA 100, so Nasdaq buy, USA 100 buy. A lot of ones, another one here saying USA 100 buy. So hopefully we've got a lot of happy traders because we've seen a lot, some nice upward, strong upward price movement. But let's go back to a 3-minute time frame. Let's then go to today's price movement on gold. Let's find gold. There we go. So this is gold, ladies and gentlemen. Now, gold, we're trading above the trend line. We're also trading, here we're above the 75 bar exponential moving average. Like I said, we're trading above the price sentiment line, which is the 100 SMA. We're also trading above the neutral level on the RSI. If we're looking at the neutral level on the RSI, currently we're trading slightly lower here. And we're also trading slightly lower on the real candlesticks itself. So we're still seeing convergence. Now, if we start to see, ladies and gentlemen, that the price increases in value, let's say the price, does something like this. So, the price increases like that. Now we're on a higher high. But if the RSI is still tilted lower, this is what is known as divergence. Now, if we're getting divergence, that may be an indication that gold is overbought, is trading above its intrinsic value. So at the moment, we have a bullish bias for gold here. We're trading above moving averages. We're trading above the RSI at neutral level as well. We're currently trading at 67, so that's a nice comfortable level. Latest crossover is a bullish crossover. Let's switch over to a 3-minute time frame as well. If we're looking at a 3-minute time frame, we're maintaining mainly above the 200 bar simple moving average. Latest crossover, ladies and gentlemen, is also a bullish crossover. MACD is slightly above neutral. It's not significant. Ideally, I'd like it to be significantly above neutral, but it's slightly above neutral. So still having a bullish bias, ladies and gentlemen. Now, a lot of people will be entering into instant buys. Why? Because if people wait for the breakout up here, then we've missed already quite a lot of price movement. Whereas if we enter instantly now, which is a slightly earlier, lower level, you've got that benefit of an earlier entry. Now, what if people are cautious about that and they're slightly worried about entering at that level where there hasn't yet been a breakout, I want to remind people, keep in mind that gold has been one of the best performing commodities of 2024. Also, generally speaking, over the past few years. Keep in mind on the 2-hour and 3-minute time frame, all indicators are bullish indicators. Even as we're speaking, we can see it's increasing in value again. So we're pointing out the indications, and we really can see it's increasing in value significantly. But if people are cautious, keep in mind you don't have to open a very large trade here. Sometimes we see large institutions that drive the price lower than all of the other lows to try and knock out a lot of stop losses. And also to trigger a lot of sell orders, because if there's a lot of sell orders, they can more easily enter buys and ride that upward price movement. So if people are cautious, they don't have to open their whole trade here. They can open a buy here and then open a second buy here. The only thing I would say is, if you're going to open the second buy, be cautious to not, trade and speculate against the trend. So there's a difference between having a buy signal here and then coming down to here, but then seeing a buy signal again, rather than just seeing a lot of downward momentum. You just keep speculating against the trend, in which case there's risk of doing that, ladies and gentlemen. But other than that, again, we can definitely see indications of bullish price movement as well here, as we also can see here, because we don't actually have any divergence. Now, some people are saying US dollar, what should we be doing with the US dollar? I've got one person here, EURUSD. It's actually an academy who's asking. EURUSD as well, another person's asking. Do we have any other currency pairs? Let's see if anybody else is asking about currency pairs. No, so far people have only asked about the EURUSD. So I'll start with the EURUSD and then I'll cover other currencies. If we look at the Euro USD, we've got that shot upwards. But keep in mind, we've got that shot upwards. We're still at a lower level based on the previous high. We're still below both trend lines, and we're still below the neutral level on the RSI. So what we need to be cautious about is that we're not going to go, we've gone to that level, but we're not going to go to that level and then do something like this, because that's an issue. That's a lot of this is a 2-hour time frame, so it's a lot of price movement against you that, of course, people really want to avoid without doubt. So that's something we need to be cautious about. But before we continue looking at this, I want to point out something to people. There's a lot of people look at a currency pair as one asset. There's benefits to looking at a currency pair as three assets, because, for example, Euro USD, you're analyzing the euro individually, so that's one asset. Then you're analyzing the US dollar individually, that's the second asset, and then you analyze the Euro USD. Now, all of these should be matching up. There should be no conflicting signals, ladies and gentlemen. Because if you have conflicting signals, then of course there's a higher risk of not reaching that take profit, seeing sideways price movement, not seeing enough momentum in order to speculate, or even worse, hitting your stop loss or your trailing stop. So, of course, ideally, we want a clear trend, clear drivers within the market. So, for example, if you have the euro increasing in value and then also the US dollar increasing in value, how are you going to trade that? Yes, the euro USD may be increasing in value, but if both are increasing simultaneously, then there's a stronger risk of, even though it's increased, that it will just collapse thereafter. Whereas if you've got one currency increasing in value against the whole of the market and the other currency decreasing in value against the whole of the market, then that can significantly change the scenario. So if we look at currencies, ladies and gentlemen, the worst performing currency of the day is the Japanese yen. That's the worst performing. So potentially the worst asset that you can probably use to speculate the US dollar is going to decline is the Japanese yen. This is one area that we can look at. The other area we can look at, ladies and gentlemen, is that because that's the worst performing and there's been so much price movement against it, so the US dollar JPY increasing in value, that you're going to speculate a retracement or correction because of the news, and now that is becoming overbought potentially. Whereas the second best performing currency, ladies and gentlemen, you can see is the Swiss franc. So individuals that want to speculate that the US dollar is going to decline, potentially there's benefits of using the Swiss franc. But keep in mind, guys, that the US dollar has performed extremely well. And even though we're about to get an interest rate cut, we're also about to get an interest rate cut from the ECB tomorrow as well. And with most central banks, the only central bank that really is not expected to cut and is actually expected to hike interest rates is the Bank of Japan. So you also have to take that into consideration as well. So let's look at also other assets. We mentioned the US dollar against Swiss franc. So let's look at that, because that's most likely to be extremely interesting. Let's type it in. Apologies. So US dollar Swiss franc, 2-hour time frame. Look at this downward price movement. So this is why I said this is the second best performing currency of the day. And you can really see the difference. Look at this really strong downward price movement, ladies and gentlemen. And we're not above both moving averages. We're actually below one, and we're actually below both. It's just that the RSI is higher. Let's switch to a smaller time frame. Look at this downward price movement here, ladies and gentlemen. Very clear, bearish crossover, very low on the MACD as well. So you can very clearly see a strong price movement. The only thing I'll be slightly cautious about is if the price is oversold on a smaller time frame like this. So this is a 14-period RSI, 75, 50, and 25. No indications here that the price is oversold yet. So potentially we can speculate a price movement of something like this, for example. So the price doing something like this. What a lot of people would like to see potentially is a breakout of the level here. So basically, not opening a buy when we have, sorry, not opening a sell when we actually have a bullish candlestick. So again, a different type of price movement, and you're speculating in the completely opposite direction. So that's also in regards to the US dollar against the Swiss franc. Last asset that I'll look at, by the way, guys, if we have anybody that has any questions or certain assets that they want us to look at, of course, feel free to write it in the comments. If you're going to be using the US dollar against the Swiss franc or the Euro USD, whatever asset it may be, there's a lot of benefits to also be monitoring the US dollar index. So here you can see the US dollar index. This is why I said you need to be careful about speculating against the US dollar. Because if you're looking at the US dollar index, we're still on a higher low here. We're still on a higher high so far. We're still trading above the trend line here. Still trading above the price sentiment line. Still trading above the RSI neutral level as well. Currently at approximately 55 on the RSI. So this is also important to be analyzing simultaneously when we're analyzing the US dollar. The last asset I will look at is oil. We can see oil increasing in value. Seen a lot of indications of upward price movements. Again, we've got higher lows, higher highs. We're trading very high on the RSI as well, trading at currently above 63, trading above both trend lines. If we switch over to a smaller time frame, bullish crossover, trading above the 200. We're on a positive area of the MACD and a positive area of the RSI as well. We got a slight, very slight indication of divergence there. But if we switch over to a smaller time frame, onto another time frame, we don't have indications of divergence on that time frame. So not much there to be worried about. Some people also may look at the Fibonacci retracements and look at, if we're going to break above 65%, then use that to indicate the area. As soon as it crosses above that, start speculating upward price movement. If we are going to get a decline, we need to be cautious as it reaches the 200 bar simple moving average. That's an area we definitely need to be cautious about. Again, for example, we can see that here, and we see it on a lot of charts. As we get an increase and then a decline, as we get to that 200 simple moving average, we need to be cautious. So that's also in regards to the US dollar, the US oil. So crude oil, ladies and gentlemen. Let's go to another asset. Somebody here says if we can look at the Swiss franc against JPY, most likely because the Swiss franc is the second best performing currency, JPY is the worst performing. So that's understandable. Again, the only thing I'll be saying about that is be very cautious about high spreads. We have extremely low spreads here at HF markets, but keep in mind, certain currency pairs have high spreads in the whole market itself. The Swiss franc JPY, very thinly traded, not got the highest and not got the lowest spreads. So you need lower spreads. So you need to be slightly cautious there. Indications of buys, but we do have divergence. So there is sign there for caution, ladies and gentlemen, that actually it might collapse because we have divergence there. We have here, for example, upward price movements on the price itself, but on the RSI, downward price movements. So we need to be cautious that it's not going to be rejected at this level. If we go to a larger time frame like this, we can also see there's plenty of occasions where it was rejected at that level. We can see it was rejected here at that level. We can see it was rejected here also at that level as well. So you need to be cautious of that level because of the divergence. But momentum-based indicators, of course, will be because of that volatility, indicating at the moment upward price movement. So that's it, ladies and gentlemen, for the moment. We've been speaking now for just over 40 minutes. So hopefully you found today's live analysis session educational. We've looked at what was released on the CPI. We've looked at a lot of indications, what the latest indications are, what it means for the financial trading markets. And we really can see the indications that we looked at were very, very positive. I mean, look at the NASDAQ, which was the first asset we said would increase in value. Look how high it still is, ladies and gentlemen. So it increased all the way up to here. Whereas when we were looking at it originally, it was approximately down here, ladies and gentlemen. So most of the people that were watching and were trading as we were speaking, to be honest, probably already hit their take profits and exited the market already. But that's it for today, ladies and gentlemen. Of course, as I always say, trade safe, trade responsibly. We have a lot of educational material here at HFM. We have articles, live analysis, live trading sessions, live analysis sessions, webinars. Everything is offered for free, ladies and gentlemen. We also have ultra low spread accounts. We have no overnight fee accounts as well, so swap free trading. Everything is available for free. Feel free to register. Have a look through. If you have any questions, of course, feel free to ask us. We always have a support team available to everybody that they can speak to on the phone and also via live chat as well. So that's it for today. Enjoy the rest of your afternoon, and we'll speak again very, very soon. In the meantime, goodbye.